Hey, good morning, everyone. Today I wanted to shoot this quick video talking about covered calls plus dividends and what a portfolio might look like if you can manage both of those. Now, disclaimer, these stocks that I picked, they're just for illustrative example purposes only. And also, don't mind my dog in the background if he starts barking. He is with me in the office today. So let's go ahead and dive into it here. So these three stocks, I'm going to talk about. TSM pays on January, Abbott pays on February, and Johnson & Johnson pays in March. And then after that, those three just repeat every quarter. But with this illustrative portfolio, obviously, you're pretty healthcare based. There's only three stocks. I definitely wouldn't recommend just a three stock portfolio. I mean, maybe you could allocate 10% or a certain percentage of your portfolio to just this simple three stock portfolio, get paid monthly. But from an overall perspective, ETFs provide you with a more diversified portfolio, and I definitely would recommend that. But once again, not a financial advisor here, so do with that for educational purposes only. Like, do your own research. Not a financial advisor. I don't want to be responsible for helping you in the wrong direction. That telling you should do it this way, but it doesn't match your risk tolerance or your time horizon. So definitely, if you want professional help, seek one of them. They can help you go through those steps that are required in order to, one, determine your risk tolerance, and two, determine your time horizon. Just by those two questions, it can help you a lot as far as how risky you should be, and what types of investments you could potentially look into. But for this example, that actually looks a bit off there. Sorry. I don't know. It just says 34, but that's like the average daily volume. D6. Oh, because the trading day just started. Okay, so I was like, well, that's weird. So, but yeah, typically this will be in the millions. That's another reason that I tried to pick three stocks that have high volume. So whenever you are looking for dividend stocks that you could potentially do covered calls on, volume is an important aspect, I think, just because it gives you more liquidity. And then you can get in and out of shares, in and out of positions quicker, but not a requirement by any means, but just helps the process a little bit there. So this calculator, what you're looking at here is, like I mentioned, this stock pays dividends in January, and I believe TSM currently pays $1.80 and some change per share. So then you divide that by 4, and then we're multiplying by the number of shares we have. So this is a field we can edit. This is an auto-calculated field, and this is a field we can edit as well. So TSM is our first one. Abbott is our second one. And then Johnson & Johnson is our third one. Down here, this is going to estimate the portfolio size in order to have 300 shares of each of these stocks. This is our annual income, pretty much just adding up these three columns. And these three columns are including the annual dividend plus a projected, whatever you select in here. If you think you can create 4% on your entire portfolio, then that's where that number's coming from. So if you think you can only project, 1.79%, then it's going to drop down, a good bit there. But yeah, so each 9 times 4, right? Okay. Yeah, so this is the quarterly amount, or this is the monthly amount you're going to get. This is what that is. So this is the monthly amount. Then you multiply that by 4 to get your overall, your annual dividend, and then you add in, currently I just did. So if there's a $28,000 portfolio, projecting to get 1.79% on that, that's kind of where that number is coming from. But as you can see here, if you can create, like if you got 0 on covered calls, then the income is going to be significantly less. You're sitting at it's still a pretty healthy dividend yield, 2.21%. That's more than the S&P 500, but you're not diversified like the S&P 500 is. But the cool thing with covered calls is if you just get 2%, which I think is very possible in some markets, that your income then jumps up to 4.21%, doubles essentially almost. I guess 2.42 would be doubling, or 2.21 would be doubling. So that would be doubling. So if you were able to get that, then it's just another way to increase your cash flow from your portfolio. So think of it as like a rental property, right? Every 100 shares you have of TSM is another rental property, because then you're going to get dividends quarterly, but then you also have the ability to sell covered calls on a weekly or monthly basis on that 100 shares or quote unquote rental property. So, but yeah, so this is just a quick little calculator. If you went a little crazy, I think Divo, I was just looking at that this morning. They aim, Divo, the ETF, it's a, kind of like this strategy. They're investing in dividend growth stocks, and then they're also selling covered calls against it. But this is kind of what they're aiming for. In their fund report, they say we look for stocks that pay a dividend between 2 to 3%, and then we look to collect covered call premium between 2 to 4%. So if they did get 4%, then you can see that could be a better year potentially for income. You might miss out on some of the gains on the upside because you're taking on more risk with covered calls, but you do have more control if you do this versus investing into just a passive index funds like Divo, which, don't get me wrong, if you don't have time to manage positions, if you don't have time to invest in individual stocks, sell covered calls, then this might not be the best strategy for you. And it's perfectly fine. There's ETFs out there that will do it for you. So the performance might not be the greatest, or it might be better, but that is just something to keep in mind. If you do want to spend the time to do research on these stocks, individual stocks, sell covered calls on a weekly or monthly basis, then this could be a great alternative way to increase your overall portfolio yield. Right? Inflation is eating away every year at our wealth. So knowing how to just increase it by 1 or 2% is very crucial, especially if you have a long time horizon, 20, 30 years. If you increase your yield by 1 or 2%, you're going to be amazed to see the difference. That 1 or 2% can make. That's why they say like actively managed funds, like people make the argument of like VTI, right? So VTI is a low cost index fund, which is a great fund out there, versus like a actively managed fund that's like 1.5%. If you look at the expense ratios, VTI is probably like 0.03 or 0.06 or something like that. So very little compared to like 1.5%, which you could potentially see at some of these actively managed funds. Then over the span of 30 years, like you would be amazed to see the difference in returns. They're just eating away at 1% of your compound interest every single year. And if you know anything about if you know anything about compound interest, there's several things in that equation that makes it very powerful. First of all, is time. The longer time you have, the more powerful it can become. But then another thing to really consider is that compound annual growth rate. So if you do some illustrations, if you look at 7% versus 9%, there's a huge difference there. So minimizing your fees as much as possible can make a huge difference over the long term. But kind of got off onto another ramble there. But you can also do this with like SPY as well. or ETFs. I've thought about doing this with like sector ETFs. Like, look up spiders sector ETFs. There's like technology, real estate, financials. I was thinking about doing that in my one of my retirement accounts, just because people typically recommend to have ETFs or mutual funds in your retirement accounts, just in case you did pick a stock that went against you big time and never recovers. You're never going to get a tax benefit for writing that stock off. Whereas if you would have had it in your active taxable brokerage account and you bought AMC, or you bought a stock that went against you and you're down a couple grand, you can write that off against your sorry, the dog's in the background. You can write that off against your active income. Whereas in a Roth IRA, you're not going to get that tax benefit. So that's why people typically, sorry, my dog's playing with the toy. That's why people typically like to do individual stocks in a taxable brokerage account, and then retirement accounts, mutual funds, ETFs. But what I was saying is you could do this with XLK, XLRE, XLF. Look up spider sector ETFs. There's a lot. There's 7 or 8 out there. But you could do that as well. Create XLK doesn't pay much of a dividend, but if you get 3% of it, now it's a growth ETF producing a 3 or 4% dividend, 3% cash flow per year. So that can be very powerful. So yeah, just some different ideas I'm throwing out here. Just wanted to show you guys this quick calculator I was messing around with. But $113,000 portfolio producing a 6% yield. This cash flow doesn't look too bad. Some people could retire off this amount of cash flow with just a small portfolio. I mean, if you look at the typical is what, 4%. That's what people like to typically. So if I did 1.79, 4,500, you're still gonna get a nice little bit of. Actually, correction. This is annual. These are annual. Okay, sorry about that. This is your monthly amount. Okay, but still, yeah, I guess I didn't show in the calculation what it might look like. I could do that real quick so you guys can kind of see. Let's see here. Bear with me for a minute. Can kind of break this apart. B6 times I2. Oops. All right, there we go. Maybe. Okay, anyways, just gotta refresh this here. And then this would be the sum of these two fields. Times 4. I think I'm off a little bit here, guys. I apologize. So that is your quarterly amount, $1.80 times the number of shares. So that's your quarterly amount. Options. This should be if you sold a quarterly option. That's going to be your annual amount. Yeah. But yeah, I mean, there's some different ways. Let me just go ahead and wrap this up here. So just so you can get an idea of what I was talking about, let's just do annual dividends for now. So that's going to be your annual dividend amount across the board here. Oops, that's not what I want to do. There we go. All right. .21%, and then this is going to be our annual. Yes, fix that for me. Yes. Okay, there it is. That still seems a little bit off there. Yeah, let's go. Really, we don't even need to do that. We can do the sum of these two fields. Okay, cool. There it is. All right, so this is going to be your annual amount. Obviously, this would get broken up quarterly, and then this would be either weekly or monthly. But let's just say we got a 2% projected covered call. We got 2.21% in dividend yield. Then this is what, you could potentially see, $5,000 a year. So, $300 or $400 a month average. But yeah, I think that's it for the video. This one's a little bit longer. Apologize for that. But once again, I'll leave this one down below, this spreadsheet down below. Let me know if you guys have any questions. Feel free to like, subscribe down below. It helps us out a lot. And as always, thanks for watching and following us on this channel. Take care.